What's up, guys, and welcome back to Wall Street Millennial. One of the biggest investment stories of the past year has been the massive outperformance of disruptive technology stocks like Tesla, despite the negative economic impacts of the pandemic. Investors everywhere are scrambling to find the next disruptive technology stocks to achieve Tesla-like returns going forward. But for every Elon Musk, there are always a dozen promotional fraudsters trying to pump their own companies and line their own pockets. With disruptive technology, it's more important than ever to be selective and find high-quality companies that will actually deliver what they're promising. One common place investors look to find disruptive technology opportunities is Cathie Wood's Arkhanvest, an investment manager dedicated to finding disruptive technology. Cathie Wood and her team have a significant track record, with their flagship Ark Innovation ETF returning more than 600% since its inception in 2014. During the pandemic, the outperformance accelerated, returning almost 300% since the March lows. Besides the Innovation ETF, Ark also manages 5 other ETFs, which focus specifically on the internet, genomics, robotics, and fintech. All of them have been major outperformers over the past few years. The investment philosophy of Arkhanvest is to invest in technology companies at the early end of their adoption curves. This allows them to get in at cheap prices before the rest of the market realizes their potential. They believe that there are 4 main market inefficiencies that create opportunities for active investors. First, the market's short-term time horizon causes most investors to miss out on long-term technological trends because they are too focused on next quarter's earnings reports. Second, most Wall Street analysts think very narrowly in terms of industries, market caps, and investment styles. This narrow-minded way of thinking makes them miss out on new disruptive technology opportunities. Third, the rise of passive investing causes severe mispricings in disruptive tech stocks. And finally, most Wall Street firms have a very closed-off research process and don't interact enough with outside experts who could have unique insights about the future of technology. Here's Cathie Wood explaining how Ark screens stocks for their ETFs.
And take us through the strategies. We mentioned that you tilt towards the disruptive type technologies. What exactly does that mean? How exactly do you hone in on the stocks that go into these actively managed exchange-traded funds?
Sure. Well, our screen is not a benchmark. Our screen is our research. Our starting point is from the top down, and we're looking for learning curves or cost curve declines that are associated with technology, and they're fairly consistent over time, depending on the technology. And from a timing point of view, we want to make sure that we're ready for prime time. So we ask the question, once we figured out the cost decline, okay, for every percentage point decline in price, how much does demand increase? Are we ready for prime time? So in the late 90s, if we had asked that question about most of these technologies, the answer would have been no. And yet investors were chasing them and valuing them on eyeballs and other such things. Today, they are happening. We're ready for prime time. And the fear I see out there when it comes to volatility or disruption or anything that's not in an index is palpable. That's the real opportunity. The dream was too early. Anyone who chased it got burned. Today, they're afraid. They should be moving into it.
She says that many companies were overhyped during the tech bubble, and a lot of investors lost a lot of money buying at the top. Because of this, they are now too scared to invest in high-growth tech as they fear a repeat of the tech bubble. A prime example of this is Tesla. Many short sellers thought Tesla was a bubble because they didn't understand the long-term growth potential. Cathie Wood saw Tesla's dominance in EV technology early on and started aggressively buying the stock for ETFs. In 2019, she came out with a price target of $4,000, while at the same time Tesla was trading for around $250 adjusting for the stock split. Many in the financial establishment laughed at her absurdly high price target, which implied a 16 times gain in the stock price. But today, less than 2 years later, Tesla stock has exceeded her price target with a current valuation of $4,261 a share, adjusting for the stock split. Here she is on that same interview justifying her bullishness on the company.
We learned about their artificial intelligence chip. We saw the specs. And our analyst, James Wang, came from NVIDIA. That's what they're replacing. And he said, oh my goodness, and he's going to write something this Wednesday about it. This leapfrogs the competition. And they're at least 3, if not 4 years ahead of the competition. And then a few months later, execution went up when not only did they not lose in the third quarter $700 million, but they made, this is cash flow, $1.4 billion. So that was a miss in terms of consensus expectations of roughly $2 billion. That's what happens with exponential growth. The analysts following this stock don't know how to analyze it, because it's not a technology stock. It is that. It's not a car company. Yes, it is. Battery. It's utility. It's something for everyone, and no one can pull it all together. We have set out our research teams. We have broken them out not by sector, but by innovation platform. So we have a robotics, autonomous vehicles or robots. Energy storage, they will be electric. Artificial intelligence, they will be powered by artificial intelligence. Transportation as a service, we have 4 analysts collaborating on this. I don't think research departments out there are set up to analyze this stock. There is an amazing inefficiency in this stock. It is our highest conviction idea for a reason.
Traditional Wall Street analysts valued Tesla as if it were just an automobile company. But Ark instead looked at their technology and how they were years ahead of the competition in autonomous driving. This investing approach paid off well for Ark and its investors, with the Ark Innovation ETF massively outperforming the S&P over the past 5 years, in large part because of their Tesla holdings. Recently, Ark has been in the news again because they are planning on launching a new ETF targeting the space industry. Space represents one of the biggest investment opportunities of the next century, as technologies are finally getting good enough to provide satellite internet, space tourism, and eventually new industries like asteroid mining. Given Arkhanvest's track record, investors are very interested in which space stocks they will include in this new ETF. The ETF is expected to be released at the end of March, and they have yet to announce the specific holdings. But they did lay out the type of companies they are looking for. The key investment focuses will be reusable rockets, satellites, suborbital space, drones, 3D printing, and the underlying technologies that enable all of this. On the day of the Ark filing for the new ETF, space-related stocks soared higher across the board as investors anticipated that the new ETF would bring more attention to the nascent space industry. Here's the new ETF being announced on CNBC in January of 2021.
1. Ignition.
Looking to invest in launches like this? Well, it's getting a little easier. And it has Virgin Galactic shares rocketing higher today, as well as other space companies. The reason? Call it the Cathie Wood effect, a filing revealing that her company, Arkhanvest, is launching a space exploration ETF. The stocks in the fund haven't been named yet, but Ark is coming off of a wildly successful run in 2020. Its flagship innovation fund, returning more than 170% last year, now has $17 billion under management. The fund, perhaps best known for its bullish position in Tesla, the stock accounts for more than 10% of its weighting, which does help explain the outperformance. The new fund will be focusing on companies, quote, leading, enabling, or benefiting from tech-enabled products and or services that occur beyond the surface of the Earth. 4 categories included: orbital aerospace, like satellites; suborbital, like drones, enabling tech, think robotics or AI; and aerospace beneficiaries, like internet, GPS, or construction stocks. Mike, this was a niche little fund. Cathie Wood used to come on and everyone thought she was crazy for saying Tesla was going to 7,000. And now look at her influence over some of these names. Should you follow her and get into the space stocks?
Whether you should or not, this game has been rolling for a little while right now. The flows into her complex, into Ark complex, are massive. They were exceeded year to date so far. iShares inflows on a net basis, $4 billion. And it's not largely Tesla. It's not only Tesla. There's a genomics fund, a kind of gene editing business that they're huge holders of lots of small stocks. Now, you have a combination of things here. Huge, big themes, these disruptive themes that are benefiting from all these sort of forces that we all see in the new economy. Although also with transparency. It's an ETF. You know what stocks are in there on a relatively timely basis, so you can kind of chase in front. And what you have here with this fund is that there just aren't that many, pure space-related plays. So people are just betting first and figuring out if they end up in the fund later.
The influence of Cathie Wood and Arkhanvest is made apparent by the strong price action in these 4 space stocks after the ETF was announced. Investors started bidding up these stocks based on the possibility that Ark might start buying them. Taking a brief look at these stocks, the first one is Virgin Galactic. Run by the billionaire Sir Richard Branson, Virgin plans to revolutionize the luxury travel industry by offering space tourism to high net worth individuals. The second stock is Maxar Technologies, which makes satellites involved in geoimaging data collection from space. Their satellites are extensively used by the US government, and they have a long track record with over 2,200 years of collective time in orbit across all their satellites. Third is Iridium Communications, which operates a collection of 66 satellites which are used by a wide variety of customers. Its applications include maritime location and Internet of Things. Last off is Orbcomm, which provides satellite connectivity solutions for Internet of Things and other applications. Investors are biting their nails in anticipation of the Space ETF's launch. While the ETF won't be launched until March, Ark has actually run a space exploration mutual fund in Japan since 2018. This Twitter user claims to have a list of the mutual fund's top holdings as of September of 2020. The top 8 holdings include satellite company Iridium, semiconductor producer Xilinx, design software company Trimble, software company Splunk, as well as a few others. There is no guarantee that the ETF will have the same holdings as the mutual fund, and it's possible that the mutual fund's holdings have been updated since this filing was released. But this could give investors an idea of what types of companies Ark will choose for the new ETF. And once the ETF is launched, they are required to disclose its positions on a daily basis, so we will know what it holds the very next day. Space is a nascent industry that potentially has a lot of growth ahead of it. If you are interested in what companies are likely to be the biggest players in this industry going forward, it will be well worth your time to look at the Ark Space ETF's holdings once it's released in March. Given Cathie Wood's track record, there will likely be some high-quality companies in there. Alright guys, that wraps it up for this video. If you like this content, don't forget to like, subscribe, and share. If you have any thoughts on Arkhanvest or have any space stocks that you like, let us know in the comment section below. As always, thank you guys so much for watching. Wall Street Millennial, signing out.